Welcome to the Founders of Web3 series by Outlier Ventures and me, your host, Jamie Burke. Together we're going to meet the entrepreneurs, their backers and the leading policymakers that are shaping Web3. Together we're going to try to define what is Web3, explore its nuances and understand the mission and purpose that drive its founders. If you enjoy what you hear, please do subscribe, rate and share your feedback to help us reach as many people as possible with the important mission that is Web3. Today, I'm happy to welcome Ryan Selkis, founder of Messari, which is providing research tools for crypto enterprise and professionals. Ryan, you describe yourself as have been in crypto since it was Bitcoin 2.0, which is, of course, a reference to circa 2014 when the wider altcoin narrative began, as in alternatives to Bitcoin. Welcome to the show.
Thank you for having me.
So you've been at the heart of the ecosystem before it could begin to be considered as an industry, really, both as an entrepreneur, investor, and I guess journalist, analyst. I mean, from the media perspective, you've been an entrepreneur in residence at ConsenSys with Joe Lubin, a founding team member at the industry's most prolific investor, DCG, Digital Currency Group, and the largest trade media in the space, CoinDesk, and of course, its conference, ConsenSys. More recently, you are the founder of Messari. I believe it's just over 2.5 years now, where you've been working to bring professional grade transparency and research to the space, an industry that's plagued with opacity. And that's really delivered through, I guess, two kind of product lines. One is the Transparency Register, which is looking for kind of disclosures both from token projects, but increasingly exchanges. And then you have your kind of pro product line, which caters to professionals in terms of investors, BD, and compliance who want this kind of higher fidelity data and analytics. The reason why I want you on the show is both as a founder, I kind of regard you as the master of the bootstrap. You know, you've done it a couple of times now where you've built community in this space from zero. And of course, you have recently been acquired by On-Chain FX. So congratulations with that. And then the second area is because of your deep knowledge of the space as a byproduct of what you do with Messari, but also just because you've seen everything through this full cycle that we've had since 2014 and the great work that you're doing really to kind of help professionalize the industry. So it's a great pleasure to have you on.
Yeah, absolutely. Happy to do it and excited to dive in. I mean, like you said, I've been around for a couple of different market cycles now, less about the years and more about the different, epochs that Bitcoin and crypto in general has gone through. And obviously there's been radical change in size and prevalence in quality of builder and just the general sentiment of the market.
Yeah, and it's going to be interesting later to speak about whether you see that professionalization happening not just within the capital markets, but also within the founders, of course, at DCG. You were investing at the very early stages, roughly around a time when I came into the industry, and there weren't many quality projects to invest in. So it's going to be interesting to dive into that a little bit later. So to kind of summarize your background, to give some context. So you are an MIT MBA dropout. Your excuse was because of Bitcoin, which I guess is as good as any. Brief stint at JP Morgan in 2007. You worked at Summit Partners. I think your first startup was Good Benefits, which was looking to administer flexible workplace giving programs in 2011 to 14. You then began to advise a number of venture capitalists on performing due diligence in the Bitcoin industry, and then created TBI Consulting around 2013. That led to TBI Daily, which was Bitcoin's industry-leading daily newsletter, had over 3,000 subscribers. And I guess that led you to be headhunted by DCG, where you were Director of Growth, I believe initially Director of Investments, to be the first hire at DCG. And you co-led a lot of the seed investing activity happening there. And of course, assisted in some of the funding rounds as well as recruiting and leading the acquisition and integration of the first subsidiary, CoinDesk, which you then went on to become managing director of in 2016. Somewhere in the middle of all of that, you were also an EIR entrepreneur in residence at ConsenSys. I couldn't quite place exactly where, or when, should I say.
So this was in New York at the end of 2017. So it was a wild time to be part of ConsenSys.
Right. And then just before you founded Messari in 2018, of course, where you are CEO in the present day. So I guess that's about as crypto a CV as you could get, or, I would say Web3. And whether it's investing at DCG or covering the industry through its cycles, as you said, at CoinDesk, as well as giving the industry its first real platform with ConsenSys, the ConsenSys event, I guess the common theme across all of that that connects quite neatly into Messari is that you're very dedicated to driving forward the industry, actually putting in place a lot of the foundational pieces for it to become an industry, be considered an industry. Now at Messari, you're trying to drive greater transparency in the space. What is it that attracts you to this space? Why are you so dedicated to kind of furthering this industry?
Well, I first learned about Bitcoin back in 2011, right after I'd wrapped up my first stint in venture capital. And at that point, I knew that I probably wanted to build something and be on the other side of the table versus investing full time. And, at the time, it was right around the shutdown of the U.S. government and the debt sequester and S&P downgraded the U.S. debt. And I learned about Bitcoin just as a speculative hedge. And at the time, there was a few ways to play the trade if you're bearish on the dollar and the U.S. debt situation. You could short the Treasury ETF, you could buy gold, or you could buy Bitcoin. And I think I did the only thing that you shouldn't have done out of that trio of options. I ignored Bitcoin, I bought gold, and I shorted the U.S. Treasury ETF. And then, of course, counterintuitively, the Treasury ETF rallied on the back of the S&P downgrade because it was a flight to safety, and a lot of fear and panic in the market, and ultimately the beginning of some of the sovereign debt issues that were happening in Europe. But I didn't really do anything with Bitcoin other than loosely follow it because I'm not an engineer until 2013. When Fred Wilson invested in Coinbase and the Winklevoss twins launched their ETF application, Grayscale launched his trust, and then the Fed shut down Silk Road. So it became obvious that this was not going to be just a fringe technology, or at the very least, some other very smart investors had de-risked entry and the career risk element of getting into the space. And I kind of jumped in with both feet right around the time of that first big spike, and that coincided with Andreessen Horowitz's Series B for Coinbase. So, ever since then, my interest has always kind of been there in this long-term wariness about the U.S. debt situation and just, kind of our standing as a country when our run as the sole superpower and reserve currency comes to an end. I've always, thought about what comes next. And over time, it's become about more than just money. I think the emergence of Ethereum and DeFi has proven that not only could you have a new form of money, you could have a new entirely programmatic, decentralized financial system. The rise and success of Ethereum and crypto protocol tokens has really paved the way for new censor-resistant, Web3 protocols, all of which are insanely early. Most of them are going to fail, but ultimately kind of offer a glimpse as to what we can expect going forward as a decentralized response to an otherwise ever-growing, nationalistic and more authoritarian set of world governments and actors that are gradually accumulating power, even as things get more tenuous with the coronavirus and just the general economic and geopolitical situation. So my interest day one was, can this be a way to make money and kind of protect my own portfolio? And obviously it, along with the rest of the industry, has evolved.
And so, you describe the work that you're doing now with Messari as the S&P of crypto, but you also say that the S&P of crypto won't look like the incumbents. And you also talk about the importance of an open source ethos and a kind of a rethink of the entire reference data stack. Could you unpack that a little bit? What do you think the S&P of crypto will look like? Presumably that's what you're designing. You spend a lot of time thinking about it. And how do you realize the open source ethos, and why is that important?
For starters, there's very few top-down regulatory structures that you can rely upon, right? Everything is bottoms up within crypto. So one of the primary challenges is, how do you think about standardizing data sets? You don't have an Edgar for financial reporting. You don't have anything like generally accepted accounting principles. It's very hard to get accurate, clean data even out of the major exchanges. So in light of all that, the data that you're putting into these systems, any data system within crypto, it's going to have to go through a kind of qualitative filter, and you're going to have to develop global community-driven best practices versus top-down kind of regulatory mandated best practices on how we think about reporting, comparing apples to apples for all these different assets. So, one of the key things that we started with was almost like a decentralized Edgar data library. These things aren't securities. Some of them might be, but most of them are not per se securities. But they still have teams and communities that are actively building them out. There are governance decisions that are made on a week-to-week basis. There are updates to the roadmap, even if that's a completely decentralized process, like something like the Bitcoin Improvement Protocol or EIP process. And you also want to know how the tokens are distributed over time. Bitcoin it's entirely programmatic, but many of the other assets that have been issued subsequently, there's some kind of reserved treasury from either a foundation or founders or early investors, and you have to be able to parse out who is selling when to better understand the migration from fully private to, at least in theory, fully decentralized. By definition, you're not going to be able to get a lot of that data as one company, or you're not going to be able to kind of engineer it as one company. But we can help set some of the standards. We can help curate all these different data feeds and ultimately take a mosaic approach to solve the information quality problem that otherwise plagues the industry. So I think, you're basically combining S&P with Wikipedia or GitHub if you really want to drive towards accuracy and better professional solutions for the major players that are inevitably going to want to enter this market and not really have a good starting point otherwise.
Yeah, and I guess this is why community is so important to you, and the community that you built up around you, the following you built up around you, but also the kind of very collaborative nature of how you engage with kind of cooperation, for want of a better word, in the space. As I said at the beginning in the intro, you're kind of a master of bootstrapping community, I believe, with Unqualified Opinions, which you kind of refer to as a first product. It was initially really a newsletter that you were leveraging for content marketing, but is now being increasingly evolved into a podcast, AMA with the team. And I know you're spotlighting a lot of analysts out there. So can you talk to me about the importance of community generally and in Web3 and how you've done so well in scaling them?
I'm not sure how well we've done in particular. I think it's a kind of testament to the broader team. And to your point, it really just speaks more to the practical mission that we have as a company to actually ingest data from as many third-party sources and try to call balls and strikes from as many credible people as possible. So it's much less about, I think, active community investments per se, and more just like part of our corporate DNA, like right out of the gates. This was always part of our mission. It was always part of our kind of go-to-market strategy. And part of the advantage that we had was me being early in the industry and having a lot of great relationships with folks from, the DCG portfolio, from, my time at CoinDesk, kind of across the board. And that's, a tough to replicate network on day one for, other information providers. So I think there's certainly been, active design decisions, active decisions that we've made to ensure that we as a company are, not trying to create a walled garden, but I think it's tough for me to pinpoint, any particular decisions that we've made that are replicable versus just, really kind of finely ingrained into the company DNA.
And I guess, as you say, slugging it out over several years now with that kind of incremental community growth. So, the kind of mission that you bring to the market, this trying to improve transparency, trying to increase the quality of disclosure. How likely do you think it is that we can improve these standards of disclosure in the next few years?
Well, part of it is structural, and I think only part of it is intentional. One of the issues that we have is not that teams are trying to defraud their communities or trying to pull a fast one. There's certainly some of that. I think that was more prevalent in 2017. But the real issue is just there's a sense of like who has standing to make certain disclosures on behalf of a protocol if it's decentralized and a single company does not own it. I think there's a pretty healthy gray area between teams that did an ICO or that privately launched a network, a test network, and then ultimately went live with a decentralized mainnet, and a protocol like Bitcoin, which is almost certainly the most decentralized crypto asset protocol that currently exists. And oftentimes there's two things working against you. One, there's this issue of standing and good faith, honest answer that there are certain quote unquote disclosures that any single team cannot make. They can speak on their own behalf, but not necessarily on the part of the entire protocol. And then the other issue is just US securities law, where a lot of teams have spoken with us and they actively want to participate in this initiative, but they think, okay, even if we are a coordinator of this information versus the only single source of truth, well, that might make us look more like a reporting entity or a security, even though we're not. So our lawyers have advised against that, and I think that's just a legacy issue of 80 years of financial regulation in the U.S. From day one, if not thought that there was an outright unwillingness for teams to work on this, but for some of these structural reasons, and to the extent that there are parties that are still in that opacity rules the realm camp, they tend to be ones that have a pretty clear bullseye on their back from a regulatory perspective. And they tend to be, in the latter case, projects that have washed out or already shut down or become functionally defunct.
And so do you think that structural problem can be resolved, should be resolved? I mean, I've experienced the same thing with a number of projects that we've worked with directly or indirectly, where, as you say, they go to great pains to try to separate the equity startup, if there is one, from a foundation. And I've sometimes find it quite perverse that, you would hope that the actions of the SEC would be encouraging, greater disclosure, greater transparency in the market, fairer markets, less manipulation, etc. But I mean, how can this be resolved? Because, as you say, is it possible to reconcile a decade of securities law with this new environment, this new asset class?
I don't think so, but I think that you can use common sense approaches to at least following the spirit of existing securities law, right? You think about the SEC and most national regulators' purview, they're trying to promote healthy capital formation, protect investors, and generally just mete out fraud and abuse. And I think the actors that are proactively trying to solve some of these information problems are doing a better job in many cases than the SEC themselves, than the global regulators themselves in bringing good, healthy information to light. But it doesn't mean that you're going to see legislation or anything common sense come out top down anytime soon, right? So I don't think we're holding our breath on that. And it's not just that the regulators won't figure it out, but that by the time they figure it out, the industry will have already changed. By the time regulators were finally grappling with Bitcoin, Ethereum and the ICO boom took place. Right now that the regulators are finally thinking about the ICO boom and how to wrap their head around decentralized fundraising, now DeFi is taking off and decentralized exchange is taking off. Once they figure out, if ever, how to wrap their arms around that, it will be something else. And so the regulations that people might be looking for are consistently going to be years outdated anyway. So, I think our approach is, can we take a common sense stance here? And ultimately, when the regulators do need help, they're more likely than not to default to something that's been developed in concert with the private markets and the global markets, because you can't as a U.S. regulator, enforce, at least anymore, your will and your guidelines on global communities that might not be domiciled or have any bearing whatsoever on the U.S. market.
So I guess you could consider what we're going through now as somewhat of a birthing pains, and hopefully many of the problems around disclosure are kind of a legacy issue. But of course, as you say, with the emergence of DeFi, we have a whole new raft of things to consider. And I assume with Messari and this kind of bottom-up approach, the intention is that the industry can almost self-regulate itself from a disclosures perspective. So in terms of trying to establish fundamentals, one of the things that's always frustrated me is the altcoin narrative, in that everything else is an alternative to Bitcoin and somehow comparable with one another, even though at least conceptually they're trying to optimize for different kinds of utility. What are some kind of universal measures, fundamental measures of network health that can be used across protocols?
I don't know if there's any one definitive metric, and it is really going to vary from protocol to protocol, or at least from sector to sector, right? So smart contract platforms, you might want to look at the number of applications that are developed, the number of contract calls, the general on-chain transactions that are happening, just to get a sense for, what real developer activity looks like. And, to kind of normalize and make sure that you're not just picking up spam, you probably want to look at the gas usage or, any type of fee market for what's actually happening on chain. For Bitcoin, it might just be the price itself, because Bitcoin as a shelling point is a store of value. It's got a strong holder base, and it's more important as a digital gold than as a settlement mechanism. That's obviously extremely important too, but Bitcoin's, kind of portability and storability make it such that you'd probably want to look more at the distribution of the holder base and the length of time that some of these assets have been held to better understand who actually cares about Bitcoin and how the population of holders is evolving over time, whether it's growing, shrinking, or staying static. And then, for ERC20 applications or, all other types of assets, you could really go sector by sector if you're trying to think about the most important high signal metrics that would show some type of network growth. And it's not just about like GitHub commit lines. For decentralized storage, it's going to be how much storage is actually secured using these digital tokens. For exchange tokens, those are quasi securities, right? They're buy and burn models, and they're used as on exchange currency to reduce trading fees and kind of get access, almost like a membership model to all sorts of other services. So I think every asset is a little bit different, and the mistake that people made for a long time was thinking that these were just one size fits all, where we really take a sector by sector approach to thinking, okay, what are going to be the ultimate drivers of value for this particular asset?
You mentioned earlier that you believe the majority of the networks that are alive at the moment will fail in the long term, possibly short to mid term. I guess you could also argue that some have already failed, they're kind of zombies. But yet, their tokens still exist, they're still traded, they're almost used as a store of value rather than any kind of the intended form of utility. But the top 20 or so is relatively unchanged. So, what is the likelihood that we are going to see new projects be able to break into the market and attack that top 20 with the disadvantage of, not having been around for several years and presumably have accrued a degree of faith and confidence just because they're still here?
I think that matters for currencies. I think it's less important for most other assets, right? You look at some of the other assets that are in the top 10, like Binance, BNB, they're an exchange, right? If Binance gets outperformed by another up and coming exchange, or, Binance, the platform runs into regulatory issues and there's some reduction in trading volumes or trading volumes switch to another alternative, well, then, that asset's going to probably drop out of the top 20 or be replaced by another similar, exchange token. for, things like, Bitcoin Cash, Bitcoin SV, these forks of Bitcoin, the longer they go with basically no on-chain transaction volume and being marginalized as just a lesser version of the real Bitcoin with no other, real distinguishing or differentiating features, those could ultimately turn over. And you could have something like, called like a Zcash or Monero or one of the other privacy coins take the place of Bitcoin Cash, Bitcoin SV, Litecoin, which have no real developer activity, no real innovation going on. And those will kind of gradually, not suddenly, fall out of the top 20 and be just replaced by better options. People are not going to stay stupid forever. And by the way, the same applies to Ethereum, right? If better alternatives come along, then Ethereum or ETH2 runs into issues. Well, then you'll see Polkadot or Cosmos or any of these other layer one protocols, come to the fore if they can develop a strong, religious community of developers and ecosystem stakeholders that will reinforce the security of the network. Now, Bitcoin and Ethereum are going to be very hard to displace, but everything else, including Bitcoin and Ethereum, I think we're still so early here that I think if you zoom out a little bit, it's very possible, if not likely, that many of these turn over. Having said that, in the medium term, I think if, as Bitcoin and ETH go, so go the industry, because it would be so disruptive if Bitcoin lost its pole position as kind of the most valuable crypto asset, right? Most people think about crypto. They don't think about crypto. They think about Bitcoin. And then it's only once you've purchased Bitcoin and actually spent some time, understanding it that you even really scratch the surface of all the other assets out there. I still think we're in the very early innings, and the lack of fundamentals for and tangible price drivers that you can point to for some of these top protocol tokens just hints at how early we still are, right? Like who's actually building on, who's actually using Litecoin, who's actually building on EOS or Tezos or Tron or some of these platforms that are valued at north of $1 billion. It's still extremely, extremely small. And you can make the case that a lot of these things are valued and those valuations don't really have any real bearing on reality. But I think the only time that becomes obvious is in hindsight, and the only time it becomes obvious is when there are much clearer, superior alternatives that have emerged already.
So presumably, even looking at it from the perspective of top 10, top 20, etc., is fairly redundant, or should be fairly redundant. So because these are not comparable assets once we move to genuine utility. So I guess the assumption then is that we move to something like indices with comparable protocols. Is that the natural next step, and how far away are we from that?
People within the industry, at least, are already thinking about crypto assets in different baskets. No one in the industry is looking at Bitcoin versus Ethereum as if they're totally apples to apples. No one's looking at Binance token or stablecoin apples to apples with a volatile crypto asset. So the professionals that we talk to and the folks that are using Messari as a service, they're already trying to pierce the veil and kind of come up with their own assessments for not only what could the future value of a given token be, but what's the current base reality, and what do you need to believe in terms of key metrics and across sectors for some of these assets to not just be as valuable as they are today, but ultimately maintain any value going forward.
I mean, I guess one of the barriers to financial products based around indices is the problem of transparency. Getting an ETF for an indices in crypto at the moment is challenging, precisely because people think the assets are generally manipulated, and they kind of point to a number of different exchanges. How far away are we from being able to convince regulators that this space is reputable enough that we can start to see these products go mainstream?
Well, I think the products are only going to go mainstream if the SEC actually approves one of them. But Grayscale and their investment trust has already proven that it's a perfectly acceptable vehicle for most hedge funds and most savvy investors that want to get access to the market. So I think that's something that will evolve naturally over time.
So presumably, the capital is going to follow an interest or a belief more generally that these protocols are out there delivering real impact. But if you look at most of the usage numbers, as you say, whether it's dApps, the numbers are fairly insignificant when compared to any other kind of web service or web incumbent. Where are you seeing the most adoption happen for kind of genuine utility rather than just speculative trading?
We've seen real adoption in decentralized exchange with anything that has to do with programmable financial applications, right? Lending, derivatives, instantaneous, metered payments, anything around the money use case. I think, it certainly has interesting experiments, but nothing has hit mainstream levels yet. Maybe the closest thing that's getting close to its Netscape moment, I guess, would be stablecoins and how they're being used for inter-exchange settlement and cross-border payments and the like. But I think for a lot of people, it's frustrating to just watch the evolution of this industry and think that there hasn't been much real-world utility in terms of applications, but in some cases that misses the point because the applications the primary application has been the creation of a new independent form of money and a programmable one at that people can ultimately program smart contracts against and facilitate all types of new financial services. So the base is small, but from that small base, we've obviously seen a ton of growth across the board, whether you're talking about stable coins, whether you're talking about decentralized exchange volume, obviously asset issuance, even though it's down from 2017, like that is a killer app, the ability to create new assets, new digital goods like NFTs. There's been quite a bit of this. The question is, what are going to be the accelerants and what ultimately is going to propel the market forward. So I think that there's probably no better tailwind and catalyst than what we're already seeing with the coronavirus and all of the the push to kind of all things virtual, whether you're talking about e-commerce or virtual work or VR interactions. I think more and more of our lives, even more so than they are today, are going to be pushed online. And once you are online, you're going to want platform resistant, sovereign resistant digital currency that can be yours and isn't necessarily subject to tax if you're just talking about the virtual realm and the computer.
Yeah, I definitely think that COVID will prove to be an accelerant to virtual goods as we see this kind of blending of work and play and gaming culture permeate through the kind of DAO, the decentralized autonomous organization communities. Increasingly more wealth will be digital and virtual, and I can imagine there's already a generation out there that will only ever know that form of wealth. And so naturally this, as you say, this kind of bottom-up new financial system that we've created is going to see lots of different kinds of innovation happening. So you did a thesis, 96 actually, thesis for crypto in 2019. And you were talking a lot about, of course, there's 96 of them, so you could pick any number of them. But which of those did you see to come through? I know you talked that the ICOs were dead. You proposed that security tokens would become a thing. How are you seeing some of these things evolve? Well,
yeah, I actually wrote a more recent version in December as well with 120, basically top 10s across, a variety of different sectors, right? So, thoughts on the stablecoin boom, thoughts on Bitcoin and Ethereum and kind of Web3 and DeFi theses. And, a lot of this we've touched on, but, I generally have been surprised at how slow and how, one-dimensional Bitcoin has become in terms of upgrades, in terms of kind of extensibility of the platform. But I think that's okay because in this type of macro environment, you want something similar to a digital form of gold, and the less moving pieces, the better, because I think that's healthy from a security standpoint. And then I've been not at all surprised by all the vulnerabilities and challenges in scaling DeFi applications. But at the same time, I've also been very impressed with the growth of the stablecoin and just DeFi infrastructure market. And I think that's important because I think in the early stages, you will see, quite a bit of money lost in this experimentation phase, but that's okay. And ultimately, that's kind of a necessary evil for this particular industry. If we are going to end up having killer apps, you're going to need dozens of failed protocols and different DeFi applications to be shipped and developed before you start to see more secure, stable, reliable applications emerge. And once those are out there and we do have some critical mass, I think there's a compounding effect that has on the evolution of all other derivative applications. So maybe the biggest area that I've been surprised about the pace of growth has been in the lending side. And it's less about microloans or facilitating credit to people that have not predominantly had access to credit. It's actually about the ability to take out fully collateralized loans against long-term holdings so that you don't have to, liquidate and ultimately take, tax penalties whenever, you're trying to pare down gains. I think that is a massively, massively important driver of growth and value for, a lot of early investors and ultimately for, any investors in the next super cycle when Bitcoin and Ether have their next, bull run. You're going to see that pick up even more aggressively, and provided that the collateral ratios are not completely out of whack, which we could very well see, then pretty much everybody that's taking out DeFi loans that are well collateralized, they're probably going to come out net ahead because they were able to take out a dollar-backed stablecoin, sell that, buy a house, buy a car, buy their day-to-day goods with it, and at the same time they're not paying taxes on that. Maybe you're paying interest, but interest rates are so low right now, DeFi and otherwise, that it makes a heck of a lot more sense than paying a 20 or 30% tax on gains. So I'd say, if I were to pick three things to highlight from the previous report and kind of what's changed since then, those would probably be the top ones.
What better way to end the podcast than on that fairly optimistic, bullish note. So Ryan, thanks so much for your time. I know you're a very busy man. Good luck with the event in June, and hopefully we'll have you on again soon.
Excellent. Thank you.
If you enjoyed today's podcast, please make sure you subscribe, rate, and share your feedback to help us reach as many people as possible with the important mission of Web3.